Welcome to Financial Markets Part 2, where we delve deeper. I am going to repeat certain things because I think it's important to make those points. Before we get into the detail, again, you're going to keep hearing this from me. Savings and investment are not the same. Trading and investing are not the same. So we really got to look at what your purpose is. And when we look at trading, it can be seconds to months. Investing is a longer term view. Now, why is a longer term view important is because you have a longer period to benefit from it. So these short-term volatility, which is what sometimes traders benefit from, if you're looking long-term, you get that benefit over time. When we look at any asset class, there's a trade-off between risk and reward. And that the asset class simply refers to a distinct type of investment or to a group of assets that share common characteristics as we talked about. There's equities, there's bonds, which are fixed income. We got treasury bills, which are short-term, 90-day instruments. We got cash, and then we have the alternative investments, real estates, commodities, oil and gas, etc. But each one has its own unique risk and return characteristics that we've already seen. I think what I want to do now is break down equities a little further. In our previous section, we discussed the broad asset classes of equities and bonds. I'd like to break the equities down further. One is you can break them down between U.S.-based companies versus foreign-based companies. Now remember, a lot of U.S. companies do business overseas, and a lot of the revenue comes from overseas. Foreign-based companies often do business here in the U.S. So there's these multinationals that really are benefiting from all the different markets. But when you move into the medium and to the smaller, you have those that are more focused on that country. And different countries, as you've seen, have different growth rates. They have different rates of return. So you want to look at them and say, again, this is back to your diversification. If you want to benefit from certain things, you got to be in these different markets. You don't want to put all your eggs in one basket. The next thing to look at is the size of the company, the market capitalization. And that's the number of shares outstanding times the purchase price, the sales price of the stock. Large is over $1 billion. Medium is $1 billion to $5 billion, and small is less than $1 billion. So what we have is you take these equities and you got to break them down into domestic and foreign, and then based on size. Why is that important? Well, we look at this slide, and what you can see, this shows you returns by detailed asset class from 1999 to 2013, and then over the 20 years, the best, the average, and the worst. Now, as you can see, sometimes small stocks, 1, 2, 3, 4, they were on the top. They produced the best return. But on other times, you saw them down here being the worst. Okay? So when we look at small caps, if you were in it this year, you would have done really well. But if you were in it down here and you lost 36%, there's a big difference. So you want to balance between these. Okay? And over time, what we see is mid-cap stocks perform the best at 14 on average. But look at their best and their worst range from 40 plus to minus 42. As we work our way down to large, they're 12%, which is less, but look at the difference in variation. Okay? And that's what you start to see is that it's different. So over time, this will tell you what the different categories are performing on a long-term basis, but on a time basis, you never know which one's going to be up. It depends on various characteristics of the economy and the market. So you can see that you need to be diversified to take advantage of some of these, and some of them actually move inverse to each other. Okay, we see that the relationship between long bonds and foreign stocks in that year were related. Here, foreign stocks were on top, long bonds were on the bottom. So we do see that. Now, this next one is tough to see, but this actually shows you the same thing through 2014. The same thing is present there. Let's keep going with equities. There's also different styles of investment. And these styles are really in three categories. One is what you call growth. And these are stocks that earnings are increasing at a faster rate than the industry average. They're usually in fast and new growing industries and have the potential to give shareholders returns that are greater than those offered by the stocks of individual companies in older, more established industries. Growth stocks are the most volatile class. They have more movement. They have just as good a likelihood as going up as going down. Then we have value, and that price is driven by the cash flow and the underlying business. They're good earnings, growth potential, but they're selling below the price relative to their underlying value. So you have growth value, and then there is core, which is a blend of using a little bit of both. We'll talk a little bit more about this as we move forward. Then there is equities, and they're broken down by business line. Okay, so you have basic consumer, consumer cyclicals, financial services, real estate, consumer defensive, healthcare, utilities, communication, energy, industrial technology. Defensive meaning that they don't respond, they don't have as much growth potential, but at the same time, their downside is less. For example, toilet paper. So toilet paper would be a consumer defensive. Okay, people are still going to need that. Consumer cyclical may include restaurants, it may include car manufacturers. So there's going to be different factors influencing these. If we actually take a look at the returns, again, you see the same thing. That we see the results are different and they vary. So sometimes one's at the top, utilities were up in 11, bottom here. So we do see that. You can also look at them, the next piece you can look at them is by industry. Different industries have different results. And that you can check. Variation is caused by different economic expectations for each one. One of the things you're going to keep here, past performance is not a guarantee of future results. Equities. Let's keep going with that. Stocks have risk. They can move up and down. The price of stock is driven by the market, whatever the market thinks. And longer term, it's based on expected return of the firm, the earnings. What's the cash flow that's going to be thrown off by the company? So if a company is expected to do well and generate a lot of cash, you would expect the price to continuing to move forward. Now that includes the impact of macro events. If the price of oil drops, like it did, we could see oil companies hurt. Or you could see companies that utilize oil and gas, their prices, costs going down, so it could be better. Then there's actions of the firm, management, products, processes, innovation. What's going on at the company? What are they doing right? What are they doing wrong? What's a local thing that's impacting them? This is constantly being monitored by investors and analysts and traders who support these firms and look at them and know everything that's going on. They sometimes know more than the firm itself. The value, though, of a firm is essentially driven over time by the cash flow. And that really becomes important as your long-term investor is ensuring that the cash flow is there. Long-term, by the way, doesn't mean you buy and hold forever. It means being smart about it, but having a buy and a sell point. From different points of view, the market is very funky because at times you have short-term versus long-term. And right now, traders and corporate America is primarily focused on quarterly results. What happened this quarter? What happened today? Not what has happened over time, what it looks like, but that one quarter. And you've got to be cautious of that on a long-term basis, looking for trends. And equity markets focus on short-term results and news. Let's now take a look at what a bond is.
You probably know investors use bonds to add income and diversification to their portfolios. But what exactly are they? A bond is a security that represents an agreement to repay borrowed money. Bonds typically have the following characteristics. An issuer. This is the entity that has borrowed the money. Issuers include the United States government, states and municipalities, and corporations. Principal. This is the amount of money borrowed by the issuer. Because issuers may borrow hundreds of millions of dollars at a time, the principal is divided into units, each called a bond. Bonds are typically issued in units of $1,000 each. Maturity date. This is the date when the issuer must repay the principal to the bondholder. Maturities usually range from several months to as many as 30 years. Interest rate or coupon rate. As with any loan, the issuer pays interest on the borrowed money. The rate of interest paid by the issuer is usually determined at the time the bonds are issued. The rate of interest you'll earn depends on the price you pay for the bond when you buy it. Let's look at an example. If a company issues a $1,000 bond with an interest payment of 5%, the company will pay the bondholder $50 per year. At maturity, you would be paid the entire $1,000. When choosing a bond, credit ratings are an important consideration. Businesses with lower credit ratings are generally considered riskier and must pay more interest to attract buyers. Therefore, lower-rated bonds pay higher interest rates. Buying a variety of bonds across interest rates and risk profiles can help keep your bond portfolio diversified. Bonds are generally considered a safer investment than stock of the same issuer. Just a small allocation to fixed income can help you diversify and significantly reduce volatility in your portfolio. Also, keep tax implications in mind. Many government-issued bonds pay interest-free from federal or state income taxes.
Okay, that gives you a basic overview of what a bond or fixed income is. When we look at them, we look at them by maturity. Short term is less than 5 years, medium term 5 to 10, long term greater than 10. So when we're looking at these maturities, we're trying to put them in these categories, okay? Because they're performing as a group, and this can help you evaluate the risk and the reward potential. One of the things that was said in there is, how does a bond perform under changing prices? Now, if you look, this is say a bond issued for 1,000, 4% interest rate at par. So as long as the interest rates are at 4% for that, it's going to stay at the par value. However, if market interest rates were to go down, that bond is still paying 4%, so that would mean that there is an increase in the price of the bond, a premium, so that it returns a 2% rate. And we can see the same thing here, that is, if rates go up, that investor who buys that bond still needs to get a market rate of return. In this case, it's 6%. But if you hold the bond to maturity, you have no gain or loss, and you will continue to get that. Now, we looked at this price behavior for a second here, and I'd like to introduce something that was not in the video, and that is duration. Okay, it's not maturity, and what this figure called duration does is it rolls up several bond characteristics into one number, primarily the maturity and the interest rate or coupon that is paid. And it indicates how sensitive a bond's price is to interest rate changes. So short duration is less sensitive than with one with high duration. So if rates were to change by 1%, a bond with a 5-year duration would lose about 5% of its value. And if it went down by 1%, it would pick up about 5%. So that's a brief review of bonds. Okay, we've now looked at equities and bonds. You're not just looking at picking stocks or bonds, but you're looking at a portfolio. Your entire retirement assets or your savings assets, or what your goals are, is a portfolio. It is a mix of different asset types. You need to develop a strategy or approach to managing it. That may include identifying your goal clearly. How will you know if you're successful? What are the measurements around success? What criteria will you use to select an investment? When will you sell an investment? You need a criteria to buy, and you need to know when to sell. You can't just trade stocks or play with them. That simply does not work. You can have a longer term portfolio, which is an investor, remember the difference. Investor, long-term, higher risk, higher reward. Medium term, you're more looking at average risk, average return. Short term, lower risk, lower return. So depending on your goals. So when you're going to build this, you need to take into account that every asset has a level of risk. One asset and your risk is too concentrated. Reduce the risk of volatility is achieved by diversification, as we talked about. And diversification is the act of a variety of assets, not just one or two similar ones. A diversified portfolio has less risk. Each holding may perform differently. This chart here is really an academic one, and what it really shows is that when you look at portfolio performance over time, 91% of a performance, 92, it's between 92 and 96, is based on how you allocate your portfolio. Allocate it to stocks, and then breaking that down into foreign and domestic, small, medium, large, by investment style, growth, or value, and by sectors. So that is really the biggest results. When you look at stock selection, which is second, is only 4.6. Okay, market timing, minimal, and then other factors. So these are the factors, and this is why we're spending so much time on this asset allocation discussion, is because it's one of the biggest drivers of performance. So when we're looking at that, it's about how do we mix them together opposite your financial goals, the time you have to invest. You have 30 plus, I have maybe 10. And you have different risk tolerance. You have done your analysis, your suggested broad portfolio. I've done mine. Okay? So once you do that, you then identify subclasses and then allocate a percentage of your investment dollars into each class. And I'm just going to walk through and show you a couple of different portfolios that are there. And this is as of 4/1/14. I haven't updated it. But if we look at a portfolio here, aggressive, we can see those that have a 20% large cap, 20% medium, 20, 20, 10, 10. Over time has a return over 10 years of 8.3. 5 years, we've really been an exceptional market. So that you can actually see over time that a more aggressive portfolio over a 10-year period produces more than a moderate or conservative. And when we look at it at 5 years, they're almost even right now, and 1 year. So these are just the mix of the different sizes, international. We can take a look at the next one. It's very similar, a conservative, modeling, aggressive, and you're going to find there's different strategies. There's no one perfect one. Okay? Now, are you confused yet? Okay. You might be. So go back and listen again. It may seem overwhelming, and at times it is. And what it comes down to is most individuals don't have the time or knowledge to trade individual stocks. Okay? And if they do, they may not have a large enough portfolio to get true diversification that we talked about. And many of us have our retirement money in IRAs, 401ks, that are managed either by the employer or they're set up within a brokerage firm or a bank. So if you're confused, you're like many, but you also want to minimize not being diversified. If you buy one stock because you only got $5,000, well, then you have all your eggs in one basket. Now, to address this, about 40 years ago, mutual funds were developed to address this issue. And if we look at a basic mutual fund structure, basically a mutual fund, they bring together these, you can see this, these individuals. They purchase shares in the mutual fund. The mutual fund entity puts that money together, and then they have a set of professional money managers who select and purchase securities. And they end up with a diversified portfolio. You own a portion, you are invested with that mutual fund, and you have a share in all of these diversified assets. This, for many people, for many years has given them entree into the equity markets. It's helped them stay diversified, which is an important thing, and participate. So let's keep going. These are big things. There's actually thousands of them out there. They're bought and sold daily based on the value of the underlying securities at the end of the day. So you buy them, but you're not going to know what the price you're going to pay is until you know what the underlying portfolio has done for the day. That's a disadvantage. You may have an idea what it's going to price at, but you don't always know. Mutual funds have the ability to grow the fund as it took in more investors. The major providers are Vanguard, T. Rowe Price, Fidelity, Schwab, etc. And there's thousands of these mutual funds. Okay, just thousands of them. And that is, how do you select them? Well, a couple of things. Let's stop and look at, no discussion of mutual funds would be complete without costs. Okay, and costs reduce your return. The first one is sometimes there are commissions or loads paid on the sale of that mutual fund. It's either on the front end or the back end. So you could end up with less money going in. So you might have a 5% upfront load, you put in $1,000, that would end up with $950 being invested. So you'd have to make up that $50. No load funds do not charge a sales fund. In today's day and age, nobody. Why would you pay a fee to buy a fund? There's so many out there. Vanguard, T. Rowe Price, all of them with no loads, no sales commissions. And honestly, there's no performance difference. If we took and looked at the funds that charge loads or commissions, there's no performance difference except for that fee, that sales fee. We then have what's called 12B1 fees, and these are fees for the marketing of the firm. So the firm has to sell these funds to keep things going, and that's a fee that the fund pays for. Then there's management fees. The way it's structured is the mutual fund hires an advisor to manage the fund because it's a legal entity, it's a trust. And then the advisor manages it, they get a management fee. Then there's transaction fees. This is every time you buy or sell a stock or a security or a bond, there's a fee, a brokerage fee. Then there's accounting and legal fees. When we look at this, costs really make a difference. And you have to look at mutual funds on a cost basis. Now, when there's so many to pick at, Morningstar really is the best place to go to sort through these. Morningstar, what they do is they are a research company. They do not sell mutual funds, but what they do is provide analysis to individual investors. Hopefully you've signed up for your free subscription. And what they have done is they have come up with a star rating. And what they've done is assign stars a rating from 1 star to 5. And as you can see here, that it's almost a normal distribution. So you have, here's a low 1, 10%, 10%, 5, and you have a normal distribution here. So basically, they're rated for up to 3 periods. They're rated on the past 3 years, 5, and 10 years. Okay? So that gives you a real sense of the method. This is how Morningstar sees them. Not that past performance is an indication or guarantee of future performance. Important statistics that help you evaluate mutual funds. The first is we call beta, and that's a quantitative statistical measurement of the volatility of a given mutual fund. But it's in relative relationship to the market. So it looks at the movement of that stock price relative to the S&P 500 over a period of time. Generally it's 5 years, and they look as to how it moves relative to the S&P. So if a fund or a stock has a beta or 1, it's more or less volatile as the whole market. If it's above 1, say it's 3, that is much more volatile than the market as a whole. So if it's less than 1, if it's less than 1, it's less volatile. So if you're looking at a fund and you're not really comfortable with a lot of volatility, you want to look for a lower beta. Okay? And if you want more volatility, you would go more. And that may be more from a trading perspective, but this gives you an idea of the volatility. It's a measurement of the volatility. The next thing that funds use is alpha. And that's a measure of the performance of the fund that's risk adjusted. So that's the difference between actual performance and the expected performance given its level of risk, or beta. Okay? If an alpha of 1 means it outperformed its benchmark by 1%. If it's less than 1, it underperformed the benchmark. So you're always trying to have an appropriate, you want a fund that is going to create alpha, in other words, be compensated for the risk that you are taking, given the beta, or the volatility. So there's the beta, the alpha, and the last one is standard deviation. And hopefully everybody's taking a statistics course and you have an understanding of what that is, and that's a dispersion around the mean. The more spread out the data, the higher the variation. In stocks, it's known as the historical volatility based on its annual return. So if we're looking at a standard deviation of 10, that means it performs over a period of time plus or minus 10% if the standard deviation is 10. So if the performance is 20 and the standard deviation is 10%, then you would find that that would be plus 2 to minus 2. So it's more of a measurement of the volatility around that. Now, let's take a look at what's happened over the past few years. There's been the introduction of something called an exchange-traded fund. And these are like mutual funds, except they're traded throughout the day. Okay, so you don't have to wait till the end of the day to get it. They're meant to be traded also. Most of them are what we call passive, and they try to achieve certain benchmarks. We're going to talk about this shortly. Their costs are extremely low, and almost a third of the market volume in equities today is now in ETFs. They reckon they're almost $1.5 trillion, or 10% of all financial assets. There's thousands of them also, and they track different things. The question comes up with exchange-traded funds that are passive or index is, can you consistently beat the market? So if we're looking, exchange-traded funds are like a mutual fund. They're diversified, but they're like stocks in that they're tradable during the day. And that's where you have ETFs that are diversified funds that trade like stocks through the day. That's the big difference. When you're dealing with exchange-traded funds or mutual funds, you still need to select the funds that expressed your view on the market, where it is, where it's going, and where do you think the opportunities are. The largest funds are the S&P 500, SPY, the Russell 2000, and Double Q, Power Shares, NASDAQ 100, and then the MSCI Emerging Markets. These are the largest exchange-traded funds. If we look at the other examples, this chart here actually shows you the name of the fund, the ticker symbol, and then what is the tracking goal. So these actually track indices, okay? And the reason they can keep their costs so low is that, for example, they can keep their costs low because they're not doing a lot of research. So in Spiders, the SPY, all they're doing is buying every share, every stock that's in the S&P 500. So it's fairly easy. You're not doing any analytics. It's simply tracking the index. And there's different ones by where they are. You can look at, you want energy, you want finance, you want technology, you want healthcare. Then there's bonds, international. And then there are a few of these actively managed funds, okay? Which means they're not following an index. Most exchange-traded funds are following some form of index. Here's a list as of May 27th
of the top 100 exchange-traded funds. And you can see these here, what the symbol is. Everything is by a symbol. Closing price, the change for the day, and then what's the year-to-date return. And you can see they're all over the place. Okay, so that's what's out there. As you move into Project 3, I would encourage you to look at the top list of exchange-traded portfolios. Morningstar has the same information on these that they do on mutual funds. Let's take another look here at what conventional wisdom would say. And that would say that analysts can determine which stocks will outperform the market through fundamental and technical analysis. And managers can outperform the market by picking the best stocks and bonds. And that they could use tactical allocation to shift in and out of sectors and, in extreme cases, out of asset classes. Their belief that markets are inefficient and they can find these opportunities. And the market timing is possible. You can guess the tops and the bottoms. That's the conventional wisdom that drove mutual funds but drove money management for many, many years. The past 3 to 5 years, there's been some massive changes in thought as people become more educated and more research was done. So what's the truth? The first is active management is characterized by persistent underperformance. Market timing is not merely ineffective, it's almost detrimental. And the cost of active management comes not only from underperformance, but in high trading cost and fees as well. And I've been struggling with this for a while to think, well, no, you can beat that. The bottom line is one cannot consistently beat the market. Underline the word consistently right here, consistently. Let's look at this chart. Okay, this is over the past 5 years, the column in red. You can see the percentage of funds who were outperformed by their benchmarks. Okay, that means the fund didn't achieve the benchmark. If we look at all large cap funds, big stocks, 87% did not meet the benchmark. That means they didn't achieve what a simple index did. Take a look at some of these. Mid cap, 92, 85, 91, 90. In some of the multi-cap mixes, maybe a wee bit better, but when you look at it, overall, you cannot beat the market consistently. Does that mean that some do? Yeah, some clearly do. But over time, they don't. So you're paying a fee, if you think about it, for not even achieving the benchmark. So why not just invest in ETFs? And that's become a real... why not just invest in ETFs? You'll get a market rate of return, but you won't beat it, nor will you miss it. I think there's a place for both in the portfolio. The other piece here is market timing. Basically, if between 1993 and 2013, and all of these numbers I can update, it's just some of these charts don't really change, is that if you're fully invested during that period, you got a return of 9.22%, okay, the average annual return. But look at if you miss the 10 best days, you're down to 549, miss the 20 best days, down to 3, miss 30, 40. So if you're trying to get in and out, you may actually miss a lot of market opportunity. So you need to be in the market. Costs and fees. No sales or loads. The broker commission, $10 a transaction. Some are no transaction fees, depending on where you are. Fees are very low because you don't need a team of analysts. ETFs average about 0.40, and they range from 0.05 to 1. A blended portfolio can be around 0.09. Mutual funds average around 142. These are actively managed mutual funds. Some mutual funds track an index or a mix of index and active trading. But that's pretty cheap. So if your return is only 5% for the year and you're paying 142, that's going to bring you down to 358. If you're trading that here, you're going to have a significantly better performance. And when you look at this on a comparative side-by-side, capital markets work and price securities are fairly priced.
If there's daily movement and volatility, traditional, they often misprice. Commercial benchmarks define the strategy, pick stocks and times markets based on security. So one allows the benchmark to decide what you're doing. It accepts slightly lower returns and less trading costs in favor of tracking. They generate higher expenses, trading costs, and excess risk. We can look at a lot of different portfolios can be made up totally on ETFs. And this one here is I put together for you just to see. This is from iShares. You can go look it up. BlackRock is one of the largest issuers. And you can see how they have a fund that gives you exposure in the different areas you might like to be in. So what we're going to do now is we're going to actually look at some discussion to get you up to speed. This is what's currently going on as people move away from mutual funds into ETFs. Let's talk about that because there's sometimes there's blurriness, and then there is also something called strategic beta. So we're going to listen to these two, and let me know if you have any questions.
Hello, everyone. I'm Ben Johnson, Director of Global ETF Research for Morningstar. Today, I'm pleased to be joined by Rolf Agather. Rolf is the Head of Research North America for Russell Indexes. Rolf, thanks for being here.
Yeah, thank you, Ben.
So, Rolf, what we've seen in the U.S. over the course of the past few decades is this secular shift towards index investing, whereby index funds, be they traditional mutual funds, exchange-traded products, now account for nearly a third of all assets and managed products in the United States. Now, the debate tends to get hung up framed in terms of active versus passive, and became pretty heated last year after active managers really lagged pretty badly virtually across all asset classes. Is the active-passive premise a solid premise, or is it sort of a false context?
Yeah, I think it's definitely getting blurred. I mean, indexes have always had an important role in the investment process. So, decades ago, they were first designed to measure asset classes like U.S. equity, like fixed income, and they were also used as benchmarks for active management. So I think, that popularity then, obviously helped us understand, how active management was doing, and as you suggest, it also helped us understand when active management wasn't doing so well. But increasingly now, indexes are being used as investment strategies. We hear a lot of talk about smart beta. We're definitely developing new sorts of indexes that allow people to get exposures to different parts of the market. So it's blurred, I think, where now you can take an index and actually make very active decisions about the types of stocks or the types of weighting strategies that you want in your portfolio.
Now, when we talk about this evolution of indexes, they've gone, I think, or come a long ways from being this broad market barometer, something you see printed across the masthead of the Wall Street Journal every morning, and towards being an investable strategy. What are some of the things that are important for investors to keep in mind when they think about an index no longer as a benchmark, but now increasingly as an investment strategy?
Yeah, I think the two key features that we always highlight with indexes is the fact that they're rules-based, so they're objective. So as I like to say, as we're running the index every day, as we're rebalancing that index, there's a set of rules that we follow. So really, regardless of market conditions, you as an investor understand what those rules are and know what we're going to do in any situation. And as part of that, there's also the second feature, which is transparency. So obviously, once we've set up the rules, we need to make sure that you can get access to those and read those out on the web or through any sort of documentation we have. So I think just the fact that you have transparency and objectivity are two key features. And then we need to look at other things like the turnover of an index. In some cases, these strategies can have fairly high turnover, which can create costs for investors. So there's very practical considerations like turnover. Another consideration would be liquidity. Sometimes there are stocks that may not be as liquid that people can really get invested in. So we do have to be careful about including those stocks in some of our indexes.
Now, I think a useful example to sort of frame all of this is the Russell 2000, a benchmark that's very near and dear to your heart, one that has come under criticism. Our own analysts have really taken a fine-tooth comb to it in looking at it as a potential and looking at it relative to other small-cap indexes. Now, I think what you're describing in terms of understanding index methodology, that process, and the end product is absolutely critical. So when you think about the Russell 2000, its process, that end product, in relative to other alternatives that are emerging in the marketplace. How would you frame that?
Yes, and I think it's a great example of the fact that, that index was designed to be the best representation of the small cap market. And if you think about the small cap market, you're going to expect potentially higher turnover, that as companies that were small get bigger, you might have to sell those out of a portfolio if you want to maintain that exposure. Also, we know that small cap potentially can have less liquidity, or stocks can be of a smaller size. So it's interesting that as the best representation of the small stock market, that also potentially gives you some of those characteristics, which hopefully benefit you, the investor. Your ability to potentially withstand higher turnover, your ability potentially to hold less liquid stocks. So I think it's the fact that we're representing an asset class that has those characteristics that makes the Russell 2000 so valuable.
So it's really important to understand that the Russell 2000 at its inception was designed with the intention of being a benchmark,
yes,
being a barometer,
that's right,
and not an investable product necessarily.
That's right. And obviously we've done things, we've evolved the methodology over time to make it more investable, but there's always that natural trade-off that any index provider has with really trying to maintain that representation of the exposure, because the investor ultimately wants to know what they're getting, but also balancing out some of the trade-offs you have that can have very real costs to the end investor.
So as you're describing it, Rolf, it sounds like there's really a learning burden that investors are facing as it pertains to understanding index process as defined by methodology, understanding the end product, and understanding how that stacks up relative to other investment alternatives. It's almost as though we're back full circle at a due diligence process that we'd use in vetting traditional active managers.
That's right, and I think we really want to make sure that investors don't lose sight of that most critical decision, which is asset allocation, that it's not as simple as just picking the best stocks or picking the best mutual funds, that what indexes hopefully help people represent is the types of exposures that you can get in the marketplace. So there's definitely many more choices available in terms of the areas of the market you can invest in, the types of strategies you can employ. But again, you need to first focus on what are your unique circumstances, what are your investment objectives, and then come up with an asset allocation that can be implemented either with an active product or an index product. So there's definitely more choice, which then creates the need for more education for the investor.
Well, Rolf, I appreciate you being here with me today.
Yeah, it's been great. Thank you, Ben. I appreciate the opportunity.
For Morningstar, I'm Ben Johnson.
For Morningstar, I'm Jeremy Glazer. I'm here today with Ben Johnson. He's our Global Director of ETF Research, and take a look at the state of strategic beta exchange-traded products. Ben, thanks for joining me.
Glad to be here, Jeremy.
Let's start by just looking at the growth of these so-called strategic beta products over the last couple of years. What are these things, and why have they become so popular?
Well, strategic beta, or so-called smart beta, represents really a hybrid of active and passive. It sits in this middle ground between active and passive. So like active funds, strategic beta exchange-traded products and mutual funds track an index that have an active bet embedded in them from the moment that their methodology is locked in. Now, like their passive parent, strategic beta benchmarks are transparent. They're investable in a sort of rules-based manner, and they're investable at a very low cost. So it's this combination of active and passive where we find strategic beta.
And this has been gaining traction recently?
Absolutely. So if you look at the U.S. marketplace as it stands today, there's an excess of $400 billion invested collectively in exchange-traded products that we define as fitting into this strategic beta bucket. That figure has been growing at about a 20% compounded rate for a number of years now, and what we see is that it's accounted for a disproportionately large percentage of net new flows into exchange-traded products, and we've seen a lot of product development in this space as well, and it's grown to the point where today it accounts for about a fifth of the overall U.S. exchange-traded products pie.
So what kind of investors should be looking at these kind of products? How does it fit into a portfolio?
Well, the fit really depends on the investor, and it depends on the use case. So what we see is investors of all stripes are using these products in a variety of different ways. If we break it down and we look at it more granularly at the different sort of subcategories of what we've referred to in very broad terms as strategic beta, what we see is that globally the largest subsegment is equity income oriented ETPs. So exchange-traded products, exchange-traded funds that track some sort of dividend-focused index. And what that tells us is that in a yield-starved environment, investors are using these broadly available, very transparent, very efficient, very low-cost tools to juice their yield in their equity portfolios. And that applies in the U.S. chiefly to advisors and individuals. Now, in other contexts, what we see is more narrow, more focused, targeted factor exposures that are being used in a very precise fine-tuning of risk exposures by very large institutions. So a perfect case in point there is the Arizona State Retirement System that worked in conjunction with BlackRock iShares and MSCI to develop a targeted suite of factor-specific tools, ETFs that are designed to capitalize on momentum, designed to capitalize on quality for their use in, again, very finely tuning the risk exposures of their overall portfolio. So it's a whole spectrum of investors that are using these implements for a whole variety of different uses.
So this is obviously a broad set of investments, but when you look at the space, what are some of the funds that you think are kind of worthy of a place in your portfolio and maybe some ideas that aren't quite fully baked yet?
Yeah, so I think two of the funds that we really like, that we think are most suitable for a long-term core equity holding covering U.S. stocks would be the PowerShares FTSE RAFI 1000 ETF. The ticker for that is PRF. And what that embeds is a unique discipline whereby this underlying benchmark regularly and very sharply rebalances towards value and weights based on the fundamental value of the underlying securities. So what you've seen over time is that methodology has fared very well, particularly coming out of downdrafts in the market. It rebalances into pain and discomfort, sort of feasts when there's blood in the streets, and it's available at a low cost. The other one, which is more of an equity-oriented income strategy, would be the Schwab U.S. Dividend Equity ETF. The ticker for that is SCHD. This is a very low-cost way to get exposure to a very high-quality portfolio of dividend-paying blue-chip U.S. equities. Those are two of our favorites in the context of a core long-term U.S. stock holding.
So there certainly are some strategic beta funds that sound like they do have a good role in people's portfolios, but there probably are also other ones that maybe you should be a little bit more skeptical of.
Absolutely, and I think investors at large should approach this category with a healthy degree of skepticism, just as they should to any investment that they're looking to make, particularly because this is a space that's been very long on marketing hype and is not always equally long on real investment merit, real substance. So there's a whole host of more esoteric, very high-priced, high-cost funds that are coming out there that again, I think are longer on marketing than they are on investment merit. And it's important that investors, I think, first and foremost, look at the costs, because first and foremost, what you're seeing is that there's this emphasis on quote-unquote innovation, on differentiation that's being done in many cases at investors' expense. It's used as a justification for relatively higher fees. So it's incumbent upon investors to approach this with a keen eye on costs and make sure that they're not paying active management prices for passively managed products.
Ben, thanks for your take on the strategic beta landscape today.
Glad to be here.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
So now I think you're getting the sense of ETFs, mutual funds. ETFs have a lot going for them. They're fairly straightforward, and for a beginning investor, they're important to use in your portfolio. In some 401ks, you're not going to have ETFs, you're going to have mutual funds. There's a lot of mutual funds that are also passive and match an index with the low cost, not actively managed. Right now in my personal portfolio, of about 75% in stocks, equities, half of that is in exchange traded funds, and the other is following a strategy that I've developed. Where do you get market information? There's a lot of information. One, you've been reading it every day, the Wall Street Journal. That has a lot of information. You have CNBC, a big television production. Sometimes it can be a little negative, a lot of noise. Then you have Kramer America. You might want to watch him. He's at 6 o'clock every evening on CNBC. The Financial Times of London, it's printed in pink. And then there's Bloomberg. Bloomberg is the Cadillac, is the top of the line. The Audi, the Mercedes, the Lexus, the Jag, you name it. Top of the line information source. So you get a lot of information from these sources. We also have Morningstar, which you're getting information from. Mutual funds provide a lot of information. iShares, Spider, T. Rowe Price, Vanguard. There's a lot of information there for you. Now, these are ETF mutual fund providers. So now I think you're getting the sense of ETFs mutual funds. ETFs have a lot going for them. They're fairly straightforward, and for a beginning investor, they're important to use in your portfolio. In some 401ks, you're not going to have ETFs, you're going to have mutual funds. There's a lot of mutual funds that are also passive and match an index with the low cost, not actively managed. Right now in my personal portfolio, of about 75% in stocks, equities, half of that is in exchange traded funds, and the other is following a strategy that I've developed. Where do you get market information? There's a lot of information. One, you've been reading it every day, the Wall Street Journal. That has a lot of information. You have CNBC, a big television production. Sometimes it can be a little negative, a lot of noise. Then you have Kramer America. You might want to watch him. He's at 6 o'clock every evening on CNBC. The Financial Times of London, it's printed in pink. And then there's Bloomberg. Bloomberg is the Cadillac, is the top of the line. The Audi, the Mercedes, the Lexus, the Jag, you name it. Top of the line information source. So you get a lot of information from these sources. We also have Morningstar, which you're getting information from. Mutual funds provide a lot of information. iShares, Spider, T. Rowe Price, Vanguard. There's a lot of information there for you. Now, these are ETF mutual fund providers. Then we have investment banks. These are banks that create markets, they bring securities, do initial public offerings, help with debt restructurings, work on mergers, and these are the big names. Okay, financial advising. They're in the wealth management, the trust business, wealth management for multi-millions of dollars. They also manage money for pension funds and such. So you have the big ones: J.P. Morgan Chase, Citibank, Deutsche Bank, Goldman Sachs, Merrill Lynch, Barclays, Credit Suisse, just to name a few. Then you have Analyst Research. What do analysts do? Well, obviously, they analyze. They follow up on a list of companies. They build models to project results. They speak with customers, suppliers, competitors. They build expert networks of what's going on. And if somebody has a product such as the Apple iPhone, which is made in China, they know every supplier, every part, the weather, and everything else. They prepare financial estimates. They determine a price target and recommendation. Well, where do you get that research? Well, Wall Street analysts provide it. Investment banks, research firms, Sabrient, S&P Capital, Morningstar, Thomson Reuters, Cleveland Research, Wall Street Journal. Some of these are higher level and they're free, available, and others you have to pay for. Your Wall Street Journal has a lot of analysis in it too. So that's where you get your info. Okay, I'm going to go and take a risk and go a little deeper as to how you analyze. And what I'd like to do is just share with you an approach that I've been using because I've studied a lot of different ways of researching and doing analysis. And what I found is this approach called fusion, where I bring the different disciplines together. Obviously, I got to take a macro analysis. Where do I think the market is going? Is it going to go up? Is it going to go down? Is it staying the same? And that's based on your view, my view, and yours if you're approaching this, of the economy, the growth. What's happening in Ukraine? What's happening in politics? What's happening around the world? I'm going to look at what the actions of the investors are. If a lot of people feel we're going into a recession, their actions, even though they may be inaccurate, okay, can affect the direction of the market. I look at the economic conditions that I've shared with you already: employment, inflation, inventory, consumer spending, and that impacts the potential profit of a company and its stock price. Government actions. What is the Fed going to do on interest rates? Taxes, the Asian trade policy, budget impacts, strikes, and what's going on in the world. What's going on with foreign exchange rates? We've seen things happen all over the place. With the strengthening of the dollar, diplomatic relations can cause stocks to go up and down. We're establishing relationships with Cuba. So these are the macro things. And when I look at them, I say, how do they impact the firm? Do they cause sales to go up or down? Will it impact the price? Will it impact their costs? So I look at something I'm analyzing with this macro view. Then I move on to what's called fundamentals. And that's basically, how does the business work? What is its competitive strength? What does it do? What are the actual results? What are the financials? I study the Form 10-K, which is the annual report filed with the Securities and Exchange Commission. I look at price-earnings ratio. Historically, what they are, and that's prior year earnings per share divided by the market share price. And see how that compares. What's it looking forward on a forward basis? Do I see any gaps there? I look at growth in the company, in sales, okay, in profitability. I look at the current year, 1 year, 3, 5, 10. Then I look at the total return. I'm looking at the details. Then I look at what we'll call technical analysis. And these are, I look at technical analysis. Charts and graphs, which are statistically computed. I look for buy and sell opportunity. I look for when the market might be converging or diverging. The one thing I've learned in my statistics is the trend is your friend. What is a trend? How long is it? Well, it's a point of view. Is it 3 months, 3 days? What's a trend? Trends do reverse, but they tend to move directionally. And when we look at technical analysis, we look at 50 and 200-day moving averages. Is the trend going up? Is the trend going down? Is there support at a certain price, or is there resistance? So a lot of it is around averages. Average, volume, high, and low. That's technical analysis. Let's now take a look at what I mean by technical. What I've done is I've taken you into my trading platform, my personal trading platform, to show you what technicals are about. And these are graphs. And what I've selected here is SPY, which is the Spider 500. And what I've done is I set the time period daily for the past year. So the first thing you see are these little, look like candlesticks. So if you're looking at a green, that means it closed up at this point today. If it's red, it closed down. And the difference between them is the range that it traded within the day. So we can tell here that it closed positive, it closed up for the day. Okay. On June 17th last year, opened at 194.02, closed at 194.83. Here we see it on the other side, it came down. We've seen it open at 195.61 and close at 196.98. So these are called candlesticks, okay? And they give you a sense that there's volatility within the day. And some people actually trade this volatility within the day, because here you could see that the low of the day was 207 and the high was 210. So there really was movement that you could have taken advantage of here. Now, I put in two lines, trend lines. The blue one is a simple 50-day moving average, and the white line is a 200-day moving average. Now, from statistics, remember that a trend is going up. So we see this as an upward trend. We see most of the data points being over the 15 days, which is telling us it's a little stronger uptrend. We do see that it dropped down a couple of times in the past year, well below the 200 back in October. But it really has held since last October above the 200-day moving average. So we got the trends up, the data points are over the 50-day moving, so we have a positive trend. So this is talking about market momentum in movement. Can it change? Sure. These are the variations within the day, okay, that we saw. This is the volumes, and what we can see is where you become concerned and watch is when you have a large price movements on higher volumes, either positively or negative. So this gives you a sense that the trend is happening. Let's just take a look at QQQ, which is the power shares, and we see the similar thing, except we don't see here, we don't see it drop as far as it did on the SPY. Now let's take in one. I selected this one because I know the stock. Century Aluminum. Oh, what have we here? Well, the trend was going up, and then boom, all the data points, all the closes are below the 50-day. So this is a downward trend, down, 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 down. Here it crossed the 50, crossed the 200-day cross of death, as it's referred to statistically. So what you have here is you have a downward trend. So I use this information not necessarily to make a decision to buy or sell, but it's supportive of my decision. So I might like something, but if I see something like this, I'm not going to jump in. So I'm going to look for positives, and then I'm going to look at this. If I go back to QQQ, and I see some days that it's really bounced back down like here, well, I'll buy, okay? Because I think it's a buying opportunity. I look at other things too, but this helps me make entry decisions. So hopefully this gives you a sense of what technicals is about. The last thing I look at, and I really depend on others for this, it's called quantitative analysis. And this uses measurement, performance, valuation. It's incredibly complex mathematical and statistical modeling. It's really out of my realm of knowledge, but a lot of people work on this. It's a powerful tool, tremendously powerful, but it rarely tells a complete story. So you need to bring in everything, qualitative. In financial circles, quantitative analysts are affectionately referred to as quants, quant jockeys, or rocket scientists. So that's really the process that I use for evaluating investments. Many different ways and approaches. Each one has advantages and disadvantages. There's no one way. There's many different ways and interpretations of data. Different people have different objectives, and they see things differently. Either way, you need to have a criteria for buying, whether this is stocks or mutual funds or ETFs. And when I look at stocks, do I want companies that are growing, say at 10%? May I look at EPS growth of 20%? A strong buy? Recently upgrade? Pay a dividend? No debt? So these are criteria that I use for buying. But one of the things that a lot of people don't do that's important, when are you going to sell? It's easier to buy than to sell. What price does it have to get? What's your upper limit and lower limit? Generally, if you bought and it's down below your limit, it's not going to come back. Okay? It's simply not if that's the trend is going in the wrong direction. Or a certain event occurs. But change in expected earnings, analyst downgrades. So you've got to set criteria for buying and selling individual stocks up front. You can't just go in and buy. You've got to avoid the emotions, if you will. That requires you to come up with a strategy. What approach are you going to take to achieve your goal? You need a general approach. Then you can expand and modify it based as things move forward. Remember, the higher the risk, the higher degree of price fluctuation, and the higher the potential reward. Okay? And the opposite is also true. Some other ones you might find, open the bird cage in the morning, and whatever the stocks the birds pick on, I'll buy. A set percentage to each major asset class. A set percentage in U.S.-based foreign. Equally developed between size, a mix of investment styles, using the criteria of a famous investor. Warren Buffett has been incredibly successful. Maybe you should follow what he does. But you can follow these model portfolios and develop your own. Many of them are available online. So now, I hope you're ready. So this concludes the lecture part, and
What is application project 3? Well, watch the next video. Those fees are.